Okay.
Okay. All right. Good morning, everybody. This is Jennifer, my friend Kristen. I'm super excited to have her on today. Kristen totally works in a different realm than me because it's all about money. She is the money woman, and I love it. So I've heard her speak a couple times before, and I like the way that she makes it approachable, because a lot of us get insecure and have anxiety around money and we don't know what to do or talk about it or whatever. So I really, really like the way she makes it so approachable. I could do her formal introduction, but you guys know I like to keep these webinars pretty laid back. So just trust me, you're not going to want to miss what she has to say. And I can't wait to find out what I learned this time, because like I said, I've heard her a couple different times and it's always something juicy and good. So without further ado, Kristen, thank you so much for coming on today. And I can't wait to hear all about what you got for us today.
Awesome. Thank you very much for having this and hosting this. You know, money is that thing that it'll make people crazy. It's very, very emotional. And one of the things that we like to do is create space and energy for people to come and learn those things. Because about money, right? I think we're all really, really interested about it, but nobody really talks about it. It's super, super taboo. And I think most people are very good at making money, very good at spending money. But how do we make money work for us? That's the piece that we're all really, really curious about. And so I thought today I would share the 3 things that you have to have in place in order to make your money work for you. And then the 3 things that you have to have in place in order to protect that money. Does that sound fair? Does that sound good?
Awesome. So really quick on housekeeping. I always keep everybody muted until, except for me, so that I can ask questions. But if you have a question that you want to ask while she's in the presentation, use the chat box. And then what we'll do is when she's done, then we'll open everybody up on there. You can open your own mic so that you can get on here and ask her questions yourself. So a little bit of housekeeping. Sorry.
All right, cool. So I'm going to actually share the whiteboard so that I can draw pictures and tell stories, because everybody's brain works a little bit differently. And usually when I have the words and the stories with the pictures, people get a really good sense of what that looks like rather than just hearing it, because that only hits one piece of it. What makes my job, let me make sure. Yeah. Okay. Clear. So make sure this is going to write. Okay. So what makes my job so amazing is that I help people create what they ultimately want, which is a big old pile of cash. So let me ask you, can you save $5 a day?
Everybody surely could, right?
Right. Yes. Most people's knee-jerk reaction is yes, I can. So if you could do that and I get you a good interest rate over a long period of time, that equals $1 million. What happens a lot of times is that people are like, yep, gung-ho, I can do $5 a day. And then they do the math, because we generally think about our money in terms of monthly, right? And so we do this times 30, and they say, Kristen, I can do $5 a day, but I can't do $150 a month. Now, maybe you're in that space where that felt a lot differently. Like you felt it in your gut. You're like, oh yeah, I could totally do $5 a day, but not 150. That feels way differently. But is that logic or is that emotion?
It's totally emotion, mindset.
It's total emotion, right? So this is that piece where I get to say that most of us are pretty emotional about our money. And one of the things that we know is that when we make any kind of decision, any financial decision, when we have high emotions, then our decisions don't necessarily end up being really, really good. And so the more logical you can be about your money, the better your decisions become. And so when we sit down with people, oftentimes we'll run their finances through a funnel. So we'll look at things like their mortgage. You know, if anybody's ever refinanced their mortgage, if you can lower the interest rate, you put more money into your pocket. We'll look at, auto and home insurance. We'll look at taxes. Because if you're one of those people, sometimes more often than not, we run into people who are like, oh, but I like my tax refund, that big old tax refund that we get at the end of the year or in April, because that's my savings. However, Uncle Sam does not pay you any interest, and we don't loan our money for free to anyone. Agreed? So we want to make sure that you're either paying just a little bit or getting just a little bit back, because that just puts more money into your monthly budget every month, okay? So we'll look at taxes, we'll look at life insurance, health insurance, all of those things, life. And usually we'll find somewhere between $200 to $300 a month that you're paying to someone else instead of to yourself. And so when we put that 200 into there, that equals 1.5. So I just showed you how to become a millionaire. Now, if I had come and found you at graduation, high school graduation, or even college graduation, and showed you this, how happy would you have been?
No kidding, right?
Yeah, super happy. But sometimes the hardest part is, how do I get started? The next hardest part is this 40 years. It's that having the discipline to stay on track over that long period of time. That's the one I think that most people struggle with, is because most people don't realize that it takes about 10 years for your money to start gaining momentum. And we're kind of instant everything. We're instant everything. So that's the piece we have to, this is what we call the time value of money. And so really what it means is that the more time you have, the smaller the money that you have to put into that pot in order to get that big pile of money. The less time you have, then it's all relational. So that time piece, the more time you have, the more you can have your money start really working for you, the more that compounding piece comes into play, which I'm going to talk about next. Clear. So when we think about our money, we generally think about there being two kinds of money that's available. There's the risk kind and there's the safe kind. And under the risk, there's things like stocks, mutual funds, gold and silver. Now it's like Bitcoin is the big thing. Real estate came onto this side back in 2008 when the majority, I would say probably the whole entire United States, experienced at least losing half their equity in their homes. And on the safe side, there's things like CDs, money markets, and believe it or not, I run into people who are money hoarders. They're little squirrels, and they put their money in the mattress. And the reason why they've done that, well, so what we like about the risk side is that there's this huge opportunity for growth, but there's also a huge opportunity for loss. And on the safe side, there's absolutely no opportunity for loss, but at the same time, there's really no opportunity for gain either. And so the reason why some people might, we say this mattress thing to be a little bit funny, but the reason why some people have done that is because when you look at the last 40 years, this is what's happened. Back in the 80s, there was only about 15% of people actually qualified to be in the market. So that's where that thought process of, I have to have a whole bunch of money to put into the market to start investing came into play, because that's what used to be the case. And then over time, 401ks and all that kind of stuff became really, really big. And so it was a lot easier for more and more people to get into the market. In fact, in 1999 to 2000, that was the number one year where more stocks and mutual funds were bought than any other time period in the history of the market. And then maybe you remember this, what happened in 2001. We had the first opportunity to lose up to 42% of our money. And we went back to our clients. We said, hey, do you want to put some of your money into safe? And they said, well, I think this was a total fluke and this will never happen again. Because we just had 20 years of straight incline, and this won't happen again. Total fluke. And sure enough, by 2007, we were a little bit higher than we were in 2000, and everybody's dancing in the streets and thinking, we've made it back. We've made it back. And then 2008 happened. You guys remember that? Up to 54%. The media tried to make us feel better because they called it a market correction, right? Don't worry about it. But the rest of us felt like we had fallen off a cliff. And I don't know about any of you guys when you experienced this. This one was a little bit harder to take. My husband and I, '01 was okay. It was a little bit painful, but '08 was like probably the tipping point for us to be in this space that just utterly was not fun. I remember my husband and I looking at each other New Year's Eve on 2010 and just saying, thank God that year is over. Because it took that long for us to kind of finish going through the stuff. But then all of our people, they stopped saying never, but then they started asking when. When is this going to happen again? Because people had lost over half of their money twice in less than 10 years. And statistically speaking, there is about 75 or 71% of people who move their money from risk over into safe. And so here we are. The market's never been higher, right? 2016 actually ended up being number 2 for more stocks and mutual funds being bought than any other time period. People are starting to feel comfortable, so they're jumping back in. So let me ask you, have you been to that financial seminar where they say to buy high and sell low? They don't, right? We know we're supposed to buy low and sell high, but here's that emotion piece coming in. We're jumping in when the market's really, really good and feeling awesome. And then we're selling, down here when we're freaking out, when we're going to lose everything. So we're emotional about our money. So we asked the people around us, we said, hey, if we could wave a magic wand and create the most ideal situation for you, what would that really look like? And they said, well, I like to go up when the market goes up, but I work too darn hard for my money and I don't want to lose it. And then they laugh and they giggle and they're like, well, we know this doesn't exist. However, this middle part here, I can't circle it right now because I'm having, this has been around since 1995 and it comes in the form of an indexed account. And I'll talk about that a little bit later. So how many of you have heard of the rule of 72? Yay, Jennifer. You're cheating. Oh, you have too, Susie. All right, awesome. So, and I think there's a few more people on here that I can't see.
Yeah, I got another yes on the chat.
Awesome. So the rule of 72 is really the mathematical equation to understand compound interest. Albert Einstein, he's kind of a genius. He said, those that okay. Why is my thing being paused? Let me see. Did it pause? Oh, resume share. Okay, sorry. So Albert Einstein, he's kind of a genius. He said that compound interest was actually the 8th wonder of the world, and it was the most important discovery he had made concerning his own personal finances. And so, in fact, Mr. Albert Einstein, he died back in the 50s, and his estate earns over $10 million a year in interest. And it's because he really, really understood and had his money start really working for him. So really the rule of 72 basically says that any interest rate that you're getting year after year, you divide it into the number 72 and it tells you exactly how long it's going to take for your money to automatically double. So I've got an example here where we have triplets. They're 29 years old and their uncle passes away and he says, I'm going to leave you $5,000, but here's the deal. You have to find one place to put it. You can't add anything to it. You can't take anything away, and you have to leave it there until age 65. And the first triplet, she did what her parents had done and her grandparents had done, and they always went to the bank. The bank was feeling really generous, and they offered her 4%. And so if you divide 4 into 72, it equals 18. So every 18 years, the money's going to automatically double. So at age 47, that's 10,000. At age 65, that's 20. It's not super sexy, but it is still very magical to put your money somewhere, not touch it, pretend like it's not there, and come back, and it's $20,000, and you had to do nothing to do that. Agreed? The second triplet, she found 8. 8 divided into 72 is 9. And so every 9 years, the money is going to double. At age 47, she's already matched her sister, but she has 2 more doublings. So at age 56, it's 40,000. At age 65, it's 80. Is that a big difference or a little difference?
Pretty good.
It's huge, right?
Mm-hmm.
But the thing I like to point out is we didn't go from 4 to 24. We went from 4 to 8. So sometimes people are like, hey, I'm earning 5 or 6%. What's the big deal? That's a big deal when you can quadruple your money in the same amount of time period. The third triplet, she heard she could get 12. Now, 12 is a little bit harder to find year after year after year, but we've seen it in the past. We'll probably see it again in the future. And so 12 goes into 72 6 times. And so at age 65, it's $320,000. Massive, right? Mm-hmm. So what if I could guarantee you 18%?
18 would be fantastic.
18. The cool part, the crazy part is that you can find it every day, all day long. 29, 5K, same 65 equals $2.5 million. So the question is, where do I find it? Mm-hmm. Right? So remember when Albert Einstein mentioned that those that understand it will earn it, those that don't will pay it. So you can find 18% all day long. I think we just have girls on here. It's all in our wallets. It's all in our purses. It's that little thing. And we call a credit card. Right? They contractually guarantee to charge us 16, 18, 24, 29% to borrow their money. So if we're financing our lifestyle here, but only earning, the 8% over here, then the numbers will never match up. So we get that sometimes debt happens to good people. And so when we sit down with individuals, we like to have this conversation because a lot of people have that aha. We have a lot of people who come to the class and they're like, well, no wonder I can't pay that credit card off. No wonder. So it's really good idea to understand that piece of it. When you're looking at it, compound interest is principle number 2. So we had time value money. Compound interest is the principle number 2. Principle number 3 is actually the most powerful thing that we teach. And it concerns taxes. So it's a little bit timely if you've been working on your taxes. And really the rule is the less money you pay in taxes, the more money you get to keep. It's pretty simple, and it's actually the reason why the wealthy keep getting wealthier every year is because for every minute that they spend looking for a great return on their investment, they spend 10 minutes figuring out the tax consequence of that. And so really when you think about it, I'm just going to give you guys a little bit more than we normally do. There are 3 different tax buckets when it comes to our money. And we all get to start with this one. It's the taxable one because we all have to make money first. Okay. The next one is the tax deferred bucket. So that includes things like 401ks, IRAs, SEPs, KIOs, for blah, 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 blah. We call it alphabet soup, but this is qualified money. And the last one is tax-free. That includes things like a Roth or tax-free retirement. Okay. So let's say that I have a way for your money to double every year for the next 20 years. Okay. And we're going to put it into one of these two buckets here, the last two, and grow our money in a non-taxable environment. So 1 doubles to 2 to 4 to 8 at the end of 20 years. It's $1,048,000. Okay, we love that because no taxes were paid and no fees too. So that's kind of a big one too. But let's say that you forgot everything I taught you when it came to your taxes, and you found the exact same program where it doubles every year for the next 20 years, but let's just say you're in the 28% tax bracket. So 1 doubles to 2, but because you made $1, Uncle Sam wants his 28 cents. So you end up with $1.72. Follow? That doubles to $3.44. Taxes down to $2.96. Doubles to $5.92. You end up with $5.09. Same 20 years. If this is $1,048,000, 28% tax bracket, what do you guys think that bottom number is? I will tell you, my most popular guess is $250,000 because they know that if I'm talking about this, it's a pretty big deal. My next popular guess is $700,000 because they just take 30% off of $1 million and call her good, do the math that way. But if you were thinking $500,000, you were pretty close because you at least had one number right. The actual number is $51,353. It's only $1 million difference. This is why the wealthy keep getting wealthier, because they are very, very mindful of how they help their money work for them. Huge, powerful. Did anybody have like, oh my gosh, are you sure? I see Jennifer making faces. That is the number. It's only $1 million difference. And if we lived in California or New York, it probably wouldn't be a big deal. But I don't think anybody's from there right now. So if you are, I'm sorry. But for everybody else, $1 million is a big difference. Mm-hmm. The difference between these two buckets then is when you pay your taxes. And so let's just say that rather than being the gurus that you are and what you do, that you come into a plot of land and you decide that you're going to become a corn farmer. So you go into the seed store and you say, hey, I need some corn seed because I'm going to grow some corn. And they're like, oh my gosh, we got this memo from the IRS today, and it says that if you buy corn seed, you don't have to pay any tax on it today. And you're like, sweet, let me double that order. So you're on your way out with your 2 buckets of corn, and they're like, oh my gosh, I just put my glasses on and I read the really, really fine print, and it says that if you don't pay your taxes today, you have to pay it in the fall on the entire crop. So let me ask you, when would you rather pay your tax? Would you rather pay your tax on the seed or on the entire crop?
Yeah, the seed for sure. Yeah.
The seed, right? So then the question is, would you rather have that whole million or just some of the million?
All of it.
All of it.
Give me the money. Show me the money.
Right? So that's part of the question, right? That has to be part of the conversation, because if you don't put it in the right tax bucket, you might only get some of that. And then the question next is, have you ever asked yourself, what's my tax rate going to be 20 or 30 years from now? Nobody ever has. I think I've only ran into one person who actually said yes. And so I've been doing this for a little over 4 years, so that's pretty impressive. But nobody ever asked them, because it's always been told to us that our taxes will be lower when we retire. That's what we've always been told, right? Mm-hmm. And maybe that was the case, but let me give you a little bit of tax history. Is back in the 50s and 60s, the highest tax rate at that time was 90%.
Oh, jeez.
Yeah. We were asking the ultra wealthy to stroke a check because we were paying for 2 wars cash. Then the 70s came in and the tax rate dropped down to 70%. Then Reagan came in, he dropped it down to 28. And you know what it's been doing ever since then? Getting a little bit higher, right? So last year it was 39.6, and then you got to add state tax on top of that if you have it. I know Alaska doesn't have it. But then it dropped down to 36% with the new tax law. And we got a little bit of a debt problem. So let's put it another way too. Let's say you do everything right. Let's say you pay off all your house, right? You have no more mortgage payment, which means you have no more interest deductions. You successfully kick all of your kids out of the house. You lose that deduction, right? Jennifer's getting ready to kick the last one out, right?
Yeah. I'm curious to see what's going to happen when I talk to my tax gal next week, because
I know
she turned 18, so I lost her last year, I think. So like when we do taxes this year, will it stay this year?
Well, so Jennifer would be the one to answer that question, I think. But I think you almost get to claim them until they're almost 26, as long as for like health insurance and that kind of stuff. So it kind of varies.
Okay. So we'll see what it says on the tax deduction.
Yeah.
Yeah.
So it gets a little funky. But yeah, so you could have to pay more. And that's the thing. We have no idea. That's the missing puzzle to that little bucket right there.
Right.
This last bucket, the tax-free bucket, we pay our tax today because we know what our tax rate is. And then when we access the money, we get to access it 100% tax-free. Okay, so that tax piece is really unmute. Really, really huge. All right, so 3 principles you have to know in order to make your money grow: time value of money, compound interest, tax, understanding that tax piece. The less you pay in taxes, the more money you get to keep. Now, so let's get into what do you have to do in order to protect your money. So I'm going to come back to that indexed account thing, that go up but never go down. So do y'all know who Warren Buffett is?
Mm-hmm.
Yeah, he's a freak of nature, quite honestly. He, at the tender age of 11, he learned how to be very non-emotional about his money. And so he's always had very strict, money rules. And so he's very logical when he makes his decisions. And so, he gets asked all the time, what are your rules? I mean, why are you so successful when it comes to money? He's like, well, I've got 2 rules when it comes to money. Rule number 1 is that you should never lose it. Rule number 2 is that you should remember rule number 1, which makes sense. Mm-hmm. You can't build wealth if you're losing it every once in a while. But we've all been brainwashed into thinking we have to take on all this risk in order to get ahead. And so here's how it works. It's an indexed account. And so our favorite index is the S&P 500. Okay? Because it has 500 different companies in it, large and small, all different industries. And so it's really the best barometer when it comes to the health of the economy. But it's also outperformed the Dow and the NASDAQ for the last 20 years. So it's got a really good track record. And so your money sits over here in this safe bucket. And we watch the S&P do this, right? It kind of did a whole bunch of that here recently. And so in a year that the market goes up 8, you get 8. In a year the market goes down, you hit this floor and you get 0. And so, sometimes every once in a while, I get people who are like, you're really going to honestly offer me 0? Yeah. Because you'd rather get 0 than negative anything. Could I have interest you 0 back in 2008 rather than you taking a 50% hit? Absolutely. Mm-hmm. Right?
Yeah.
What makes this not too good to be true is that for every floor that I've stood on, there's always a ceiling above my head. And so in a year that maybe this does 16, you might only get 14. Our clients are happy to give up some of the upside in order to never participate in the downside. So a lot of times people sit there and they think about this and they're like, one, how come my people have never told me about this? It's one, because there's no fees attached to this account. They can't charge any fees, so they're not going to offer it because, banks, that's how they make their money, is they charge fees. Regular stock people, that's how they make their money too. And so that's why this isn't as widely known. For every one person of me, there's 600 people saying, play somewhere else, right? Do the bank thing, do the risk thing. And so, and the other question they're like, well, isn't it all the up that's most important? No, it's actually the down, right? If you think about grades, has anybody ever gone to school? Yeah, we all have. Okay. So, and I still got kiddos in school, and I'm always, telling them, I'm like, dude, you don't want to get one bad grade, because it only takes one bad grade to ruin it.
Yeah.
Yeah. And then how many good grades do you have to get in order to bring that grade back up? Money is the exact same thing. Remember when I drew that up at, 2001, minus 42%? Do you remember how long it took us to get back to whole? 6 years. We had to have 6 years of good ups in order to get back to whole. And then 2008 went down, and then we had another 6 or 7 years or whatever to get back to whole. When that comes to compounding, that's a lot of doubling time that we've missed out on. Right? We're just making up for loss. We're not even gaining any interest at that point.
Right.
Makes sense? So when you look at what it's done, and I'm just going to do, because we're still pretty young into 18 here, but if you were actually riding the roller coaster of the S&P, the actual return is 3.98%. And the reason why I say actual return is because money and averages don't mix. It's like oil and water. The actual return is 3.98%. So if we don't go any more wonkiness like we experienced already, and everything stays the same, that 100,000 that you maybe had in there right now, it's 171, but it's getting ready to double for the first time sometime this year. An indexed account, same time period, same 100K, its actual return is 7.3. Because we just didn't play. If you look at the market any 10 years, and it doesn't matter which 10 years you pick, there are 3 downs and 7 ups. We get rid of the downs and we just play in the ups. And then out of that 7, there's really only 3 that are really, really amazing. The other 4s are just like, Like I went up, but it wasn't exciting. So that 100K here is 284 here. That's what I call winning, right? Absolutely. Because most of us are really, really busy. I don't know about you guys, but so I run a business. I have 3 kids, and then there are 3 schedules on top of that. And kids are really, really busy these days. Then we also have family obligations, outside of our own family, family that we go see and help and do all of that. And so usually the last thing that we ever make time for is the money piece. So when do we get to study and make sure that we're not losing money? Most of us are just like hoping. Last time I checked, hope isn't a plan. Or we just bury our head into the sand. All right, so that's principle number 1, is that you never lose money. Principle number 2, to protect your money. And it's one that most people don't know how to prepare for or whatever, but it is actually the number 1 reason why any financial plan will fail. And it's also the number 1 reason why anyone will file for bankruptcy. And it's because of a life event, a major life event. So how many of you have life insurance? Awesome. Why'd you get it?
for my kids. I
For
mean,
your,
yeah,
yeah,
just in case anything would happen to us, then they're not stuck with,
bills.
yeah,
Because it's not cheap to bury you.
right.
So what has to happen in order for them to get a check?
I don't even know.
You're
I know
going to
that,
have to die.
yeah, well, I mean, yeah, I know I have to die, but I mean, as far as what they have to do when I'm gone, I have no idea. One of the gals doesn't have life insurance, so I'll be talking to her.
Okay. All right. So the reason why we get life insurance is so that when something happens to us, our family is not hurt financially, right? We want to make sure everything's good. All our debts are paid off, all of that kind of stuff. So really what I'm going to talk about is called living benefits. It's built on a life insurance chassis, but the good news is you don't have to die. Something major has to happen. But there's an old kind of life insurance, which really you're going to have to take one for the team and take a permanent dirt nap. And yeah, I know I'm coming to the really kind of morbid kind of stuff, but I'm just going to say this is a pool of $1 million. And the first way it pays is if you become terminal. So you go into the doctor and they say, hey, I'm sorry, you've got 1 to 2 years left to live. You can access up to 90% of this to take advantage of any life-saving experimental treatments, or you can check off stuff off of your bucket list and say, just roll me in the ocean when we're done, okay? We actually had a client, oh gosh, it's probably been about 14, 15 years ago, a single mom, 2 itty bitties. She was battling breast cancer. She went into the doctor and he said, hey, this is the worst day of my whole entire life because I have to tell you, you need to get your affairs in order. The scariest part for her is that there was no baby daddy around and her parents were gone too. And so it was when it came to her raising those kids. And so she's freaking out. She's like, hey, I've been doing my research. They had this thing on 60 Minutes and they were talking about my kind of cancer. Can we do that experimental treatment? He's like, that's a great idea. But you said experimental, which means it's not covered by health insurance. And it's probably somewhere between $100,000, $150,000 to get started. And she didn't have that kind of money. She's a single mom, 2 itty bitties. So she's crying on her way home, trying to figure it all out. And she remembers she has life insurance. So she called her guy and she's like, hey, I just want to make sure my policy's in place. And he's like, time out. What's going on? So she tells him and he's like, you have living benefits. Let's file a claim. They filed a claim and 10 days later, she's got a check for $100,000. And she got to raise her kids because she's still alive today. That's what I call life insurance. The other way it pays is if you become critically ill. So super sick, but not going to die anytime soon. But it covers those things like heart attack, stroke, cancer, ALS, cognitive impairment, loss of sight, loss of limb, end-stage renal failure, major transplant, and a few other heart things. So if anything like that happens, are you working?
No. Yeah.
No, probably not. The doctor's going to say, hey, you need to take a time out and just get well. This is what happens is that this kind of event happens and people start to realize, oh, well, my mortgage still needs to get paid and my car payment and all my insurances and my kids like to eat. So I got to put food in the fridge. And so then they go back to work too soon and they don't get well and then they get sick again. But this is when a major illness like this is when you find out that your health insurance is not as awesome as you thought because it does not cover everything. And who does it pay? It pays the doctor.
Mm-hmm.
Yeah, it doesn't pay your copays, doesn't pay all of your increased medicine needs or any of those ancillary things that you might need. This is the number one reason why most people file for bankruptcy. The other way it pays is if you end up in the wrong space at the wrong time. So you have some kind of accident and it causes coma, brain trauma, paralysis, or burns of your body. 75%, 750. Okay. Chronic. So this looks and feels like long-term care. But if you can't do 2 of your activities of daily living, get out of bed, go to the bathroom, get dressed, take a shower, feed yourself, continence. If you can't do 2 of those, you can turn on an income, 2%, which is $15K a month for 50 months. And ladies, here's what happens. We got all girls on here, right? Mm-hmm. This is what happens. Our boys are super cute, but they're probably the one that's going to go into the home first, just because we generally outlive them anyways. And we're going to have this big old pile of cash over here, and we're going to spend all of our money on them because they went into assisted living. And then most of us get to live by the poverty level for the rest of our life. And then we're going to want to kill them again. So our needs are very, very different. We're generally not the ones who are being taken care of. Still pays if you up and die. But most of us get to get sick first and then die. And the reason why we know this is we're paying 8 of these to every one of those. Yahoo! Let me ask you this. If you were going to build a reserve of $1 million, how long would that take you to create?
No idea.
Probably your whole life, right? You can have access to this in about 4 weeks, right? Because that's how long underwriting generally takes. That's called an instant cash reserve. So this will protect that big old pile of cash so you don't have to dip into it. This will protect your most valuable asset, which is your ability to create income. And it'll give you the opportunity to either flourish in your business or do something different, but remove the financial strife so that you truly can have 100% recovery from whatever happens. So that's principle number 2 of protection. So then the last one is, that's a good looking house right there. All right, so if you're going to build a house, where do you start?
Foundation.
In the foundation, right? This is the protection phase, right? It's not very fun. It doesn't sound very exciting, but it's absolutely where we need to start. 95% of our clients never leave this phase, but they still create large piles of cash. What happened to my husband and I is that they put us here because it's sexy and it's fun. And they were like, oh my God, you guys are so cute and you're so young. You can take on all this risk. You're going to be awesome. Until we weren't. They didn't make sure our foundation was really strong and set up really, really well. So what's included in the protection phase? It's your insurances, it's your savings, it's your retirement. And yes, I said retirement because the number's too big and we're living too long. We shouldn't be gambling with it. Once that is on autopilot and it's working the way it's supposed to, and let's say you have something else extra you'd like to do something with, then you can go into that risk and accumulation phase if you want to. It's not me. That's too much brain damage. It's too big. But I just make sure that this is set up really, really well. And then the last phase is distribution. And it's a super important conversation to have. So remember that $1 million, both in the $5 a day and the tax, non-taxable presentation that we were talking about? We talked about that $1 million, right? We already asked you, how much of that do you want? All of it. Do you know how much your kids want? More. right? You're super cute. But we have to have conversations about distribution early on so that we make sure that we put it in the right space. So you saw where putting it in the wrong space could lead to you not getting all of that. And I still do plenty of stuff in that middle tax deferred bucket when it makes sense. When you have such a taxable situation that you need to put money in there, then it becomes part of the conversation. But I think most people should be totally funding that tax-free piece of it. So that's the last piece, is that distribution piece, is making up. Oh, and would it be important to you guys to make sure that you never outlived it? That $1 million?
Mm-hmm. Of course.
That's the hardest part. That's the hardest part. Nobody comes with an expiration tag like our food. Mm-hmm. I make my job a lot easier. And so I have to, part of it is, do you want all of the $1 million? Do you want me to make sure that you never outlive it? One of the biggest things that we're seeing these days is that people don't set up distribution and they're running out of their 401k money within 7 years. Most people aren't starting to save until age 53. So they're losing out on all that time. And so these pieces, there's a lot that goes into this piece of it. So we can open it up for questions. I can stop the share.
Okay. So everybody that is on, you can unmute yourself when you're ready. And we'll just open it up for questions. I know the biggest question for me is like, I'm doing okay until we get to that last little part. And it's so heavy. Like I literally can feel myself want to check out. I'm like, I just need somebody to say, this is what you do. This is how it works. And like, these are the things we need the forms that we need. Right. So that's where you come in. Right. It's like you sit down with you and you can say, this is how it works. This is what we're going to do. This is what it looks like. And all you need to do is this. Like, I really need that space. Yeah. And what's so funny to me too is like, especially in the spiritual community, it's so sad to me to see how many people are so broke, right? Yeah. I mean, this can be, it doesn't matter if it's like the Christian side of it, like it's that humbleness, like not having any money thing, but it's so funny, like even on the spiritual spectrum of it, how many people, do work for like little or nothing. And so they're barely scraping by. And so it's part of the reason I wanted to have you on, is because most of the people like me, this is so overwhelming. Like you don't understand it. You don't know how to get there. The principles of it I can get. Okay, that makes sense. $5 a day. Okay. That a lot of people would maybe say no, they didn't know if they could do $5 a day. Right. Right. The side of it that I know is that it is emotional, and it's a lot of our mindset of what we've been taught with, and the like, money doesn't grow on trees, right?
Yep,
or
absolutely.
What are all of the good old sayings that you kind of grow up that are implanted in your head? So there's two parts. It's actually learning the physical, factual part of money that like you provide to teach us how to do it, but then also balancing and learning how to clear some of that negative thinking that we've had from the past.
Yes. And that's the hardest part, right? Because some of that negative upbringing that was put into our brains, not because people were malicious or whatever. It's just, it's almost passed down, and probably what you experiencing. I mean, it's stuck in a cellular level, and all
it's
that
like a generational thing. Yeah. So I could get into all kind of the spiritual woo-woo of it, because it really can be like, it can be energetic. It can be implanted. It can be generational. It's just like energy vibration. So part of it is learning how to rethink it. And then part of it is the practical side. And the practical side is where I think a lot of people need help.
Yes. Yeah. So I like to blend both. I'm not, we have conversations around the emotional, super emotional piece. That's what we do at Wah Wah Wah. But it's twofold. So there's the work that needs to be done to fix that emotional hang up about money, whether it's evil or it's hard to come by or have to work, whatever it is. Then there's that, hey, if I had a plan, if I understood it, I can buy into it, if I can just put it on autopilot, then it makes it eases that stress. And I think sometimes that's that piece is people don't have the plan. And so they're like freaking out.
Right. Well, and I think that's why I connected with you so much, is like, you make it so okay to be wherever you're at. Right.
Yeah.
And it's okay to, so I guess everybody that's on here, I would encourage you to, reach out to Kristen and say, hey, look, this is where I'm at. What does this mean? You know what I mean? Like, give people a safe place to talk about money, because it is something that we need and we have to have it to function in today's world. I mean, that's just all there is to it. You've got to have money or you can't do anything.
Yep. Yeah.
So, I really like that part of it, that you bring it to where it's, I can do the mindset work all day long, but the practical part is what I don't get, which is why I'm so glad that you're here today. That's what we need from you. So like, if we wanted to get started on this and say we have, say we've only got, $500 in the bank, what do we do?
So really it's conversation. We can either go over what I just went over again today, but really just finding out where it is, what feels comfortable. So we have to find out what that starting pace is, and creating a plan that fits their goals. So it's a conversation, because everybody's a little bit different and where they want to go and what they want to do. But really the number one reason why anybody reaches financial success is by creating the habit of saving. It's not a sexy thing and it's so boring and everybody's known it forever and ever. It's just that we think that there's this whole get rich quick thing that's around, but it's never really existed. It just appears that way. And so, that's what I do, is I help people build habits and the right habits when it comes to their money.
So that just gave me a little chill, because this is all, so literally like now my woo-woo stuff is coming in, right? Because I'm like, this is perfect, because this is a year about foundations and about building and all of this stuff. So it's a perfect time for you to be on here with me, because spiritually speaking, this is the year, like last year with everything was torn down, right? To see what we needed to do to rebuild the foundation. And this is really the year about building foundations and getting clarity and seeing what you want your life to be like. So money is obviously a part of that, right? So this is why you can help people like get their foundation and be ready to go on into retirement age.
Yeah, it is. And and I've always just seen it like, because when the money's not right, when it's not right in your household, you're stressing about it. Your marriage is not great. You're liking your kids even less and less every day. Disliking the dog even a little bit. So when you can create that shift in that money, and make it right, then there's less stress, because one, we all get to make a financial decision every day, right? We're going to buy something, whether we go to the grocery store, whether we go out to eat, whatever. But then the other part is that really, really understanding that money. And I'm going to do another live event, big one. I need to put it on the calendar, where we're going to talk about what the law of compensation is.
I love that.
Yeah. Well, and it's part of the 12 universal laws, but once you understand what money truly, truly is, then you have this huge, major mind shift when it comes to thinking about it completely and totally differently. Like if I ask you today, what do you really feel about money? Everybody's going to have a different
different
answer.
Vibration on it. Yeah.
So, and I've had people say, I hate it. I think it's a necessary evil, all that kind of stuff. And when you have some negative thoughts about that, how can you attract it? Why would it come around you?
Right. It's so funny. I think it's been like a year and a half ago, or maybe it's been 2 years ago already. I did a presentation on what does your emotional frequency have to do with your checkbook. I was like, literally, I was telling my guides, really, you want me to talk about this? Like, I'm not a millionaire yet. You know what I mean? I'm going to throw that yet in there, because that's part of so I'm like, I really want to get there. I know you and I had a conversation a long time ago, and I thought, I want to be around people who aren't afraid to talk about money, who aren't afraid to say that they want money, because it's not a bad thing. And we've got to get over the idea that wanting money is a bad thing. It doesn't make you evil or terrible or whatever. It just means that you want your life to be more in the flow. Now, somebody can only need $800 a month to be completely wealthy. It depends on your circumstance and what you want out of life.
Absolutely. Yeah.
So, but if you need 800 extra versus 8,000 extra is going to depend on your circumstance and what you want. And I feel like it is all energetic.
Mm-hmm.
And so, and I love that about you, that you make it so common. And so like you can talk about it and not be intimidated by it.
Yeah. Well, and I think the other piece of it is too, is that most of us have been told what to do with our money.
Right. And told wrong.
Right. I mean,
So sorry, not to change the subject. We're really close to noon. So
okay.
I know we're getting a little bit over that hour mark. Somebody did just ask, living benefits, do you have to take a physical?
Yeah. So living benefits is based, they look at your age, your height, your weight, your health, all of that kind of stuff. So, and it depends on how much you get, whether or not you'd have to get a physical or not, and which company we go with. So I have ways of just going out and finding a really good company for the right fit, the right needs, and really the right budget too.
Mm-hmm.
So that piece is really huge too. Yep.
Okay.
Cool.
Any other questions, anybody? I seriously, like, the whole foundation thing is totally in my mind right now. I feel like that's huge. So, okay.
It's massive.
Jennifer, did you have any other questions or no? Okay.
No. Cool.
Okay. Alrighty. Well, I could sit and talk with you, Kristen, forever.
Yeah.
I know that you do have local meetups. So what I'll do is I'll put this information out for my group. Everybody that's on, I will send you the replay copy of this and get you all of Kristen's information. And then, she says that was great. I don't know if you can see the chat on yours.
Yeah, I pulled it up.
Okay,
yep.
Good. And so I just really appreciate you so much. I know this seems so weird for me to be like, hey, come talk on my stuff. And you're like, what? You have woo-woo people. Like, yeah, but woo-woo people need to know about money too.
Woo-woo people do need to know about money. Sometimes they have to clear their own stuff about money.
Right? Well, it's so funny, like how many people that it really is such a big thing. And I think, so regardless of what I'm doing, just what somebody else is saying, thank you. So thank you for being here. And that's really what these webinars are about, is taking everything. Because literally, like, I have another one coming up that's all about past life. You know what I mean?
Oh, awesome.
But it's because everything is so relevant. You know what I mean? Like, we've got to learn that the spiritual stuff that's happening is real. And we've got to understand that we're still human and we still need to deal with things like life insurance and money while we're here. You know what I mean? So how do we blend all that together? So that's why these webinars with all my guests are kind of all different aspects, because it's like all of life kind of coming into balance together. So I really appreciate that.
Awesome. Thank you. Well, thank you for allowing me to come and share and teach and all that kind of stuff. Cause I get to do this all day. So I'm really excited.
Well, I really appreciate it. I appreciate you coming. I appreciate you talking to us, and thank you so much for everything. And we'll make sure everybody has your information to get a hold of you if they have more questions.
Awesome. I appreciate it. All right.
Awesome.
Cool.
Thank you.
Thanks, guys. Bye, Jennifer.